Hi everyone, it's Matt Barnes here. I'm the lead trainer at Safety in the Market, and in this video I want to take you through WD Gann's 24 never failing rules for trading. So the 24 rules for trading were put together by WD Gann. If you're not sure who WD Gann was, he was a famous US stock and commodities trader from the first half of last century, and David Bowden's work at Safety in the Market, such as the Active Trader program, is based on the work of WD Gann. But Gann put these rules together after trading for a long time in the market. They appear in several of his works at different stages, and you'll see that they're slightly different or slightly fine-tuned or finessed. But I've chosen to take this list directly from one of his last books that he published, which was called 45 Years in Wall Street. So to my knowledge, this is the latest version of the rules, and you'll actually see they're really good, solid, sound rules coming from someone with a lot of trading experience. He's not someone who just came on the scene and made a fortune overnight. He's someone who was in the market for a long time. He had seen it all. He'd seen booms and busts and booms and busts and history repeating over and over again. He'd seen a lot of things in the market. He'd done a lot of trading himself. And these are the 24 rules that he said were vital for any trader. So with that in mind, let's take a look at them. So the first rule that Gann gives us is amount of capital to use. And I'm just going to read these exactly as Gann has written them. He says, amount of capital to use. Divide your capital into 10 equal parts and never risk more than 1/10 of your capital on any one trade. So for example, if you've got a $10,000 account, 10% of that would be $1,000. So Gann's saying never to risk more than $1,000 on each trade if that's your account size. Now, the reason that he says this, Gann was a very successful trader. He was followed for a month and all of his trades were documented. He showed over 400 trades, a 92% success ratio. So a phenomenal success ratio. But even when you look at that success ratio, the thing that should stand out is that if he was right 92% of the time, he was basically wrong one trade out of every 10. Now, I'm sure Gann was the same, but when I trade, I don't go into a trade thinking, oh, this trade looks a bit dodgy, this trade doesn't look very good, but yeah, I'll take it anyway. I have a clearly defined set of rules, and I look for certain things to line up before I jump into the trade. And I look for trades that have a high probability of success and are potentially going to give me a high reward for the risk that I'm taking of being in them. Okay, but I still have losing trades from time to time, and I can't tell you which of these trades, which all look good to me, I can't tell you which of those trades is going to be the loser. So that's why Gann says don't risk more than 1/10 of your capital on any one trade, because you don't know which trade is going to be the trade that goes against you. At Safety in the Market, we actually suggest risking no more than 5% on any one trade. If you risk 10% of your account, or 1/10 on any trade, you'd have to be wrong 10 times in a row to wipe out your trading account. Okay. If you only risk 5% of your capital on any one trade, you'd have to be wrong 20 times in a row before you wipe out your trading account. And in those 20 trades, you're going to learn a lot about trading. You're going to learn what you're doing wrong. And you're going to hopefully also take some winning trades as well. Remember, your winning trades should have a reward to risk ratio of at least 3-to-1. So if you lose $100 on one trade and you win on the next trade, that win should be $300 or more. So with all of that in your favor, this is a surefire way to protect your trading account long enough to learn the ropes and for you to succeed as a trader. And rule number 1 actually ties straight in with rule number 2, where Gann says use stop loss orders. Always protect a trade when you make it with a stop loss order. This is fantastic advice. If you want a career in trading, you want to be a trader and you want to make your income from trading, if you take nothing else away from this video, take this. Always use stop loss orders. Always protect yourself with a stop loss order, because you don't know which trade is going to be the one that bites you. Okay. For some reason, as traders, we don't always like to use stop losses, and there's usually two reasons that come about, or two reasons that come up when I ask someone why they don't use a stop loss order. And one reason that comes up is that people seem to have this fear that the market or their broker or somebody out there knows where their stop loss is, and if they know where my stop loss is, they're going to push the market and hit my stop loss, and I'm going to get out. So the thinking goes, I won't put a stop loss on, but I'll get out if the market goes too far against me. Now, very dangerous to think that way, because sometimes markets can move very quickly, or they can move while you sleep. You can't watch the market 24 hours a day. So in my opinion, far better to have a mechanical stop loss order locked into place, and your broker can manage that for you and get you out of the market. In my experience, very few times, if you put your stop loss in the right place, if you put it in a strategic place, there are going to be very few times that the market just comes back enough to kick you out and then runs off without you. More often than not, if it comes down to your strategically placed stop loss order and gets you out, it's going to go further against you as well. So in those cases, you're always best to be out. The other reason I have found that people don't use stop losses, and I'm as big a culprit as anyone in this, but the other reason that you either don't use a stop loss order or you might move your stop loss around is ego. It hurts to say it. It's not something we like to talk about, but that ego, the admitting that you were wrong. If I met someone who they'll just never admit that they're wrong, even when they are wrong, and you've proven that they're wrong, but they don't want to, or they don't like to admit that they're wrong. That's fine. You can survive that way in real life in a lot of situations. Often when you've got good people around you who are going to love you and tolerate you anyway. In the markets, that's going to absolutely kill your trading. Ego is just an absolute trading account killer. You have to accept that sometimes in trading, no matter how good your work is, no matter how good a trader you are, there are going to be trades where you lose. And the sooner you can overcome that ego and say, okay, I was wrong on this trade, I'll get out and I'll move on to the next trade, and it's no big deal. The sooner you're going to start making money as a trader. So really, really important there to always use stop loss orders. And as I said, if you take nothing else away from this video, take point number 2 away, or rule number 2, use stop loss orders. Rule number 3 is never overtrade. This would be violating your capital rule. Basically, overtrading comes in probably 2 forms. One is where you're taking a position that's too large. So maybe by your risk management rules, it says you should trade 500 shares or 1,000 shares, and you go and take a trade that's 5,000 shares or 10,000 shares. So you're taking a position that's too large, you're overtrading, you're risking too much, and you're putting your account to at risk. You're also putting yourself in violation of rule number 1 as well. But another form of overtrading is taking too many positions at once. You might have $10,000 in your account and you say, oh, but I'm only risking $500 on this trade, that's fine. But if you've got 20 trades on in total, all risking $500, you're overtrading. You've got your whole account at risk there. So be cautious about overtrading. Rule number 4, never let a profit run into a loss. Gann says, after you have a profit of 3 points or more, and Gann was talking about stocks here, so 3 points would be $3. So a stock moving from, say, $105 to $108. But Gann says, after you have a profit of 3 points or more, raise your stop loss order so that you will have no loss of capital if the market moves back against you. This is a little bit touch and go. You're going to need to find a balance point depending on the market that you're trading. If you're trading stocks, you might have this 3-point rule, as Gann suggested. If you're trading commodities, it will be different depending on whether you're trading a commodity that maybe trades at $1 or a commodity that trades at hundreds of dollars. It depends on what you're trading. In the FX markets, for example, 300 points is a long way away, especially with the leverage there. So you'll have to find that balance point based on what it is that you're trading. So have a think about that. But the theory is sound. There's not too many worse feelings than when you're in a trade and you've watched the market move in your favor a long way and you feel really good and you feel like you're winning and you're making money, and then the market just turns around and wipes all of that profit out and you end up with a loss. And Gann's saying you can protect yourself against that by raising your stop loss order to what's called a point of break even, which is enough to cover any brokerage on the trade and where you got into the market. So keep that in mind. Never let a profit run into a loss if you can avoid it. Okay, don't be silly with it. Some people will say if the market moves 1 tick in your favor, move your stop loss up, but you're going to find yourself getting cut in and out of the market all of the time, and it'll be very hard to hold on to a trade long enough. So great advice, this one, but you're going to need a little bit of trading experience before you start using it properly. Rule number 5, do not buck the trend. Never buy or sell if you're not sure of the trend according to your charts. And This is a really big one for us at Safety in the Market. Being aware of the trend and trading according to the trend is a big part of our trading methodology, particularly in the Active Trader program. Another YouTube video that I put out, which you can find on our channel under the trading case studies, is where we looked at the McDonald's share price and how it reacted during the cinematic release of a documentary called Super Size Me. And essentially, the point of the video, you would see that there was very bad news coming out, but the McDonald's share price kept going up because the trend on McDonald's was up. So what Gann's saying is, don't buck the trend. Just because good news or bad news comes out doesn't mean that the market is necessarily going to react in the way that you think it will. Pay attention to the trend. Be very, very cautious about buying a strong downtrend. So when the market is consistently going down, be wary of trying to buy it. And if the market is shooting up, be wary of short selling it there. Okay, so again, saying never buy or sell if you're not sure of the trend according to your charts. And that means sideways markets as well. If there's not a clear trend, don't buy or sell. Rule number 6, when in doubt, get out and don't get in when in doubt. Something that I mentioned to our coaching group the other day was the best trades I've found are normally fairly simple and fairly obvious. You'll look at them, everything will be pretty crystal clear, and you'll tick all your boxes and say, yep, there's a good looking trade, I'm going to take that. I find that if I have to struggle with a trade and I have to look for reasons to take it, I think, oh, it's sort of there, it's getting close, it might be time. You know, that sort of mentality when there's that little bit of doubt on the trade and it doesn't quite meet your rules, they're the trades that end up failing and end up going against you. So when in doubt, get out of the market, and if you are in doubt, don't jump into the market. Wait for a clear signal from the market that it's time to get in. Rule number 7, trade only in active stocks or active commodities or active currencies, whatever you're trading. Keep out of slow, dead ones. That's really good advice. David Bowden, the founder of Safety in the Market, in the case of a dead market, see, a lot of people jump into the dead market because they have this idea that, oh, it's going to take off soon and I want to get in before it takes off so I don't miss the move. David had a different approach. He was prepared to sit back and let the market go and let the market at least get started. And sure, he would miss the very beginning of the move, but at least then he would know that he wasn't in a dead, slow market. A lot of money is lost by people getting chopped in and out of trades in those slow, dead markets. And if nothing else, sometimes that's capital that you could be using somewhere else in the market. You could be investing that or trading that money in another trading opportunity somewhere else that's going to be a better use of your capital. So good advice there from Gann. Keep out of slow, dead markets. Wait till they get active. And as David said, he was prepared to let it get started. Jesse Livermore also weighs in on this. He says that a lot of money is lost in the first eighth and the last eighth of a move. So in the beginning, before the market has really sort of settled and made its top or bottom, people are trying to get in there and identify the exact top or bottom in a slow, dead market. And sometimes markets can stay slow and dead for a long time. It could be weeks, it could be months, it could be years. If you take a look at a chart of the Dow Jones Index, for example, in the 70s to the early 80s, there's about a 20-year period where the Dow was trapped in a sideways range and not really going anywhere. Okay, so don't anticipate the end of that dead, quiet market. Wait for it to get going, and once it does get going, particularly if it's been dead for a long time, you'll normally have plenty of the move left to profit from. Rule number 8, equal distribution of risk. Gann says, trade in 4 or 5 stocks if possible and avoid tying up all of your capital in any one stock. That's really good advice as well. You'll find sometimes in the market, if you just, have you ever heard of someone, they'll say, oh, I've decided to invest, I've finally done all my research and I picked this one stock, and they buy this one stock and that happens to be the only stock that goes down while everything else goes up. Now, if you've done your research properly, it's not a high probability that's going to happen, but it can still happen. You might happen to pick that one dud. But if you do your research and you pick 4 or 5 stocks, yeah, sure, one of them might go against you, but the others are going to compensate for that. David Bowden gives another interpretation of this. He says you should consider trading in a stock, a currency, a commodity, and a stock index. In other words, 4 different kinds of instrument. Sometimes stocks will be dead or not very good to trade, but the commodities will be running off, or the currencies will be trending really strongly. Okay, so by trading different kinds of market, you're giving yourself more opportunities to make money there. So consider that as well, the equal distribution of risk. Rule number 9, never limit your orders or fix a buying or selling price. Sell at market. Gann's talking about 2 things here. Number 1 is when you get into the market, when you're entering the market in a strong trend. Sometimes you want to buy a stock at $9, but it opens up at $9.05 or $9.10 and starts running away. And because you wanted to only pay $9, you miss out on the whole move. Okay, but the flip side of that is that you do have to be a little bit careful, I think, because you want to buy the stock at $9, but if it opens up at $12 and you think it's only going to $13, well, a trade that looked good at $9 is no longer that good up at $12. So you still have to analyze the trade and make sure that it's worth your time and it's got an appropriate reward to risk ratio in there. The other time where this is vitally important is when you have a stop loss order, which is where you're exiting a trade if you're wrong. If you bought a stock at $10 and you're saying, I've got a stop loss at $9, make that a market order. Don't make it a limit of $9, saying, oh, I want to get out at $9 and I won't accept anything less than $9, because if the market runs down to say, $8.90, $8.80, it may not get back up to your $9 point to get you out. Okay, so that's really good advice, particularly in the case of a stop loss being triggered. Rule number 10, don't close your trades without a good reason. Follow up with a stop loss order to protect your profits. So what Gann is basically saying here is don't cut your losses or don't cut your profits short. Let them run. So what a lot of traders will do, they'll buy a stock at say $20. The market, it might move up to say $20.20 or $20.50. All of a sudden, the trader can see $500, $1,000, $2,000 profit sitting there, and they think, oh, I want that money. I better take it before the market takes it back away from me. So they jump out of the trade. But if they've done their work properly, often that market's going to run to $21, $22, $25, and they're missing out on all of that profit. So Gann's saying, have a good reason before you jump out of the trade. And rather than just jump out because you've got a little bit of profit, move a stop loss order up slowly to lock in some profits as you go, okay, and give the market that time to move up. Now, as for good reasons to close a trade, I can think of 2 really good reasons to follow a trade, or to close a trade rather. One is when the trend changes. So if the trend is up and you've bought the stock or you've bought the commodity and the market's been moving up in your favor, and then all of a sudden the trend changes to down, there's a good reason to get out. And that's where your stop loss order is going to come in and protect you. It's already locked in some of your profits and you can bank those profits. So a change in trend is a good reason to close a trade. Another one, if you've got David Bowden's active trader program, if you've seen his price forecasting lessons, you'll know that at certain key points or key areas in the market, you'll encounter what's called a price resistance level, and you can often predict those in advance, but when you encounter one of those, they can act as a brick wall or a roadblock that's going to stop your trade or going to stop the market, at least temporarily. And they can be a great place to exit a trade as well, and that's a good reason to exit. But make sure you've got a good reason before you jump out just to take your profit. Just having a little bit of profit, I know sometimes you might have 3 or 4 losing trades, and then you see a small profit and you want to jump on it and take it. But if you want to be a successful trader in the long run, you've got to learn to let those profits run and let them accumulate. So stick to your plan there. Don't exit your trade or don't close your trade without a good reason. Rule number 11, accumulate a surplus. After you've made a series of successful trades, put some money into a surplus account to be used only in emergency or times of panic. David Bowden said something very similar to this. David said he never left all of his money in his trading account all the time. You just have in your trading account the amount of money that you need to trade. The rest of your money, you might put towards paying off your mortgage, putting into other investments. Keep some in surplus account in case you make a mistake with your trading account and you need to top it up. Or if there's a time of panic and you see some really good opportunities coming up, that can be a time where you bring that surplus money into the trading account as well. Rule number 12, never buy just to get a dividend. And this is advice that's probably going to be more relevant to Australian traders than to, say, a trader in the United States. In the US, companies don't tend to pay out dividends to the same ratio that they do in Australia. In the US, they have this mentality that if the company's making money, they can reinvest those profits in the company, and the company can grow, and they can grow the share price, and the company gets larger and larger. So they say that the investors will profit from the price rise rather than the dividend. Whereas in Australia, there seems to be an obsession with dividends, and there's a big focus on the companies paying out dividends. And one example of that are the big four banks here in Australia. And people will often, you'll see a lot of seminars in Australia where people will give you the advice, just buy stocks and hold them for the dividend. Okay, but Gann says never buy just to get a dividend. And a great example of why you shouldn't buy just to get a dividend is ANZ Bank. Now, ANZ Bank pays normally somewhere between a 4 to 6% dividend. So if you invest $10,000 in ANZ, you can expect $400 to $600 in dividend income each year to be paid back to you. So that's not a bad return, and it's generally, or it has been for a long time, what's called fully franked, which means that for some investors, they're not going to pay tax on it, and other investors will actually get tax back because of the tax credits on that fully franked dividend. So it sounds like it sounds like logical, sound advice. The trouble with that is markets don't always go up. If you look at 2015 on ANZ, the ANZ share price actually fell by 40%. So if you're holding ANZ shares, if you were holding a $10,000 position, yeah, you're going to get your $400 or $500 worth of dividends, but you're going to lose $4,000 in the share price falling. You're actually better off selling your shares, foregoing the dividend, and then buying them back when they're cheaper. And that's where understanding the trend of the market, particularly the bigger picture trends of the market, is going to save you a lot of money there. And that's a really important rule. Yes, sometimes buying a stock that pays a good dividend is a good idea when it's in an uptrend and the price is going up. But I tend to side with Gann on this one, which is to say never buy just to get the dividend. Rule number 13, never average a loss. This is one of the worst mistakes a trader can make. An example of averaging a loss is where, for example, you buy 1,000 shares of a stock at $10 and it starts falling and it gets down to $8. So you buy another 1,000 shares at $8. And if you bought shares at $10 and you bought shares at $8 and you bought the same amount, you've now got an average price of $9 for all of the shares combined, but you've got double the position size. So if the market keeps falling, you're going to be losing more and more money as they fall. The idea behind averaging a loss is people say, well, I bought it at $10, now it's at $8. If I buy some more here and average my loss, the market's only got to get back up to $9 and I can get out with a break even. Okay. And again, it might sound like sound advice or good advice, but if the market keeps going down, you're losing money at a faster and faster rate as you average down. Okay. Now, there are some cases where people will say, look, it can only go to zero and I can accept if it goes to zero. In my opinion, though, I think it's better to just take the loss, and that's certainly what Gann is recommending here. Don't average the loss, just accept your loss. Think of the example I used earlier about taking your medicine and just getting out of the trade. Never get out of the market just because you've lost patience, or get into the market because you're anxious from waiting. Gann actually says in his qualifications for success chapter, he talks about patience as being so important. And David Bowden says that there are 3 or 4 really good trading opportunities that will come on a stock or a commodity over the course of 12 months. Now, that's 3 or 4 great opportunities to make money, but there are 365 days in the year, okay? That means that there are going to be times in the market, or there will definitely be times in the market where you're waiting. You have to wait for those good opportunities. Maybe the market's just going sideways, or maybe the move has already started and it's run off without you and you've got to wait for that next opportunity. But patience is really important. If a market's moving a little bit slowly for you, don't lose patience. Just stick to your trading plan. Likewise, if you're sitting on the sidelines wanting to get in, don't enter just because you're anxious from waiting. A really good quote from David Bowden. He says it's better to be out of the market wishing you were in than to be in the market wishing you were out. So don't lose patience. Don't just jump into the market because you're anxious from waiting. You're tired of waiting. Have some patience. Rule number 15, avoid taking small profits and big losses. You've probably heard the saying, cut your losses short and let your profits run. Sadly, a lot of traders do the exact opposite. They let their losses run on and on and on because because of their ego, they don't want to take them, or they just can't stand losing that amount of money. So rather than take a $500 loss, they let it run into $1,000, $2,000, $3,000 loss. On the flip side, they also say, oh, I've got $500 in profit. I better take it now before the market takes it off me. Whereas in actual fact, they could have held on and made more money as the market went up. Jesse Livermore, again, in the book, Reminiscences of a Stock Operator, he makes the comment that traders have their mentality wrong here. He said they're afraid that their profits are going to be taken away from them, but they're hopeful that their losses are going to turn around and come good. But he said they have to flip that mentality. They have to be fearful that their losses are going to get worse, so they should cut them straight out. But they should be hopeful that their profits are going to get larger and larger, and they should give those profits time to run. And I think that's really good advice. In trading, as I said earlier, there are going to be losses. Doesn't matter how good you are or how experienced you are, you will be wrong from time to time. And the best thing to do, just cut the loss short. Just take the little loss and move on. And with your profits, give them time to grow. Let them. A market is not just going to make a profit and go from $0 to $100 overnight. It takes time. It's going to take days or weeks, sometimes even months, for that trend to unfold. So give the market time for that to happen. Okay. Don't settle for small profits, but also don't allow your losses to get out of control. Rule 16 is never cancel a stop loss order after you have placed it at the time you make a trade. I've been guilty of this in the past, and I've seen a lot of traders do this as well. The conclusion that I've come to after many years of trading is that if you're unhappy with where your stop loss is at the time you enter a trade, or at the time you're planning to enter a trade, just don't get in the trade in the first place. Okay? When you're out of the market, your psychology is at its best. You're calm. You can make an objective decision, and you generally tend to make the right decisions. As soon as you're in that trade, your emotions start kicking in. Your fear of losing money and your greed for making money can come in and play with your psychology. So if you're canceling a stop loss order or moving that stop loss order back, and increasing your risk, you're making it under a little bit of pressure. And it's generally not the best time to be doing that anyway. But as I said, be clear on your stop loss order before you get into the market, and don't cancel it. Very rarely, I can't think of a single time in my trading where I've canceled a stop loss order and it's worked out well. It's just not a good approach, not a good habit if you want longevity in the financial markets. Rule 17, avoid getting in and out of the market too often. The obvious one here is if you're jumping in and out of the market all of the time, you're going to be paying a lot of commissions or brokerage. Another thing there is if you're jumping in and out of the market, sometimes traders will see a market go up and then they'll think it's going to come back a little bit, so I'll jump out and lock in this small profit, and then I'll buy more when it goes down. But what does the market do? It just goes straight up, and then they find themselves out of a trade that they should have been in, and they're missing out on a lot of profit there. Okay, so got to be a little bit wary of getting in and out of the market too often. Now, the flip side of this is very different for a day trader. If you're a day trader, you're going to be sitting in front of the computer screen all day, buying and selling, buying and selling, buying and selling. Of course, you're going to be getting in and out of the market all the time. But just be really clear on the kind of trader that you are. That's a question that David asks us in the Active Trader program. He says, be very clear on the kind of trader you are. Are you a day trader? Live in that day trading world. Are you an end of day trader? Stay in that end of day trading world. Be very cautious about mixing the two up. Rule 18, be just as willing to sell short as you are to buy. Let your object be to keep with the trend and make money. Now, if you're an investor, if you haven't done any trading before, you might not even be aware that you can sell short, which is making money as the price falls. Um, you know, an investing mindset, people think you buy the shares and you only make money if they go up, and then at the end to close your investment or to close your trade, you sell whatever you bought, you sell the exact number that you bought. But you can actually go the other way. You can sell first and then let the market fall and then buy back at a lower price. Okay, that's called short selling. And Gann says you need to be able to do that. If you've got the Active Trader program, just check out the appendix of the Smarter Starter Pack, which is the first half of the program. It will tell you what you need to know about short selling. Okay, but you should be able to do both because as we saw, or as I mentioned earlier in the ANZ example in 2015, markets don't just go up, they also come down as well. So if the trend is down, don't be afraid of it and don't just hold on and hope. Be prepared to sell short as just as easily as you can go in and buy long and make money as the market goes up. Rule number 19, never buy just because the price of a stock is low or sell short just because the price is high. A great example of why this is excellent advice is the stock AIG, American International Group. If you open a chart up in your trading software, you'll see that it was once trading at over $1,700 per share. That's $1,700 per share. And it actually fell all the way down to $5 per share. Okay. Now, a stock at $1,700, when it falls to say $1,500 or $1,200, it's going to look cheap. Okay. But it wasn't cheap. Just because the price was low didn't mean it was a good place to buy. Okay, you wait until the trend turns around and the market starts going up, because markets can go a lot further than people think they can. They'll fall a lot further than people think, and they'll rise a lot more than people think. Rule number 20, be careful about pyramiding at the wrong time. Wait until the stock is very active and has crossed resistance levels before buying more, and until it has broken out of the zone of distribution before selling more. Basically what Gann is saying, if you're not sure what pyramiding is, by the way, pyramiding is when you're adding to your position. So you might buy 1,000 shares, and then as the market moves in your favor, you might buy 1,000 more. And then as it moves in your favor again, you might buy more and more and more. Okay, and that's a skill in itself, and it's a little bit beyond the scope of this video. But Gann is saying when you're pyramiding, don't do it within a sideways narrow range. Wait until the market has broken out of that range, either to the upside or to the downside, before you're buying more or selling more. Otherwise, you're adding to your risk when the market hasn't declared that it's a strongly trending market just yet. Okay, so I think that's really good advice for pyramiding. It's similar to the advice that Jesse Livermore offers as well in Reminiscences of a Stock Operator. Livermore says if you're buying and pyramiding, always buy at higher prices, which means that you're buying as the market is going up, as it's already moving. And if you're selling or short selling and you're pyramiding while you short sell at lower and lower prices. Okay. If you think about it, if you take one trade and you buy, say, 1,000 shares at $10, and then the market doesn't go anywhere, but you decide, hey, I'm going to buy some more, I'm going to pyramid, and you buy another 1,000 shares at $10, you're not really pyramiding. All you're doing is over trading, which is breaking your rule number 3 from earlier. Okay, and you're ending up with 2 trades. Okay, so be patient, wait for the market to break out of its support or resistance levels before you do your pyramiding. Rule 21, select the stocks with small volume of shares outstanding to pyramid on the buying side, and the ones with the largest volume of stock outstanding to sell short. So there's an interesting one. The reason Gann says look for stocks with a smaller volume of shares outstanding when you're pyramiding on the buying side is that if there's not a lot of stock out there for people to buy, and the price is moving up and people want to buy, well, they want to buy, but they can't buy because there's not much stock there, the price is going to go higher and higher as they increase their bids to go up and up and up. Okay, so you can make more money trading potentially out of shares with a smaller volume of shares outstanding. On the downside, however, as the market's going down, you want to be very careful because to exit a short trade, if you're selling short and you're making money as the price falls, if you want to close that trade, you can only do it by buying the stock back. So if you're short selling a stock with a very small volume of shares and it turns on you, there may not be stock there for you to buy back. So it can be hard for you to close your short trade there. So, if you are trading shares, that's good advice to consider before you jump in and trade a company, particularly if you're trading perhaps a smaller company. You're trading shares in a smaller company. Rule number 22, Gann says, never hedge. And what Gann means by hedging here is he says, if you are long of one stock, that means you've bought it and you're holding onto it. If you're long of one stock and it starts to go down, don't sell another stock short to hedge it. Just get out at the market, take your loss and wait for another opportunity. Again, this is that psychological factor or the ego that comes in, and you're holding a stock and it's going down and people say, I don't want to take that loss because it means I have to admit that I was wrong. So what they might do is they'll find another stock that they think is going down and they'll short sell that other stock. So they'll hope that as they make money on the stock that they've sold short, it will balance out the money they lose on the long stock. What Gann is saying is that if your stock's going down and you're wrong, get out of it. If you want to short sell the other stock, short sell it by all means. Come up with a trading plan, trade it properly as if it was any other short trade that you're going to take. But don't get the two confused just to try and hedge your positions. Gann writes a fair bit about that across his books, and he always says it's not a great idea to do that. Just treat each trade individually. Don't try and hedge one long stock with another short stock. Again, you'll see other advice from different people out there. This is coming from W.D. Gann, who had 45 years plus of trading experience in the markets. Rule 23, never change your position in the market without a good reason. When you make a trade, let it be for some good reason or according to some definite plan. Then don't get out without a definite indication of a change in trend. So basically all Gann is saying here is be definite in your decision making, don't muck around, and be professional about the way that you trade. A professional in any field doesn't just walk in and make it up as they go along. They always have a plan, whether it's a lawyer preparing for a case, a doctor preparing for surgery, they have a plan, they have a routine that they're going to follow, and they have contingency plans in there as well. So don't just change your position in the market unless you've got a good reason for doing it. The final one, Gann says, is to avoid increasing your trading after a long period of success or a period of profitable trades. And this might seem a little bit counterintuitive because as you trade and as you make money, you're going to say, well, I've got more money in my account. Why shouldn't I take larger trades? And that's fine to do over time if you build it up slowly. What Gann is saying is be wary of, if you've had 5 or 6 really good trades in a row and you've doubled or tripled your account, be wary of just running in and instead of taking, say, 2 trades with a $200 risk, risking $1,000 or $2,000 just because you can now. I've seen a lot of traders come undone there. They work very hard for 3 or 4 months, risking $200, $200, and they make $1,000 or $1,500 at a time. And then they say, right, I'm really certain about this next trade here. It's going to be really big. So they risk $2,000 or $3,000 on it, and they end up wiping themselves out. David Bowden's got a great phrase here. He says, learn to hasten slowly in the market. So when you're looking to speed things up in the market, just do it slowly. Take your time, a little bit at a time. Don't get too greedy. A great quote that I always try to remember here, if you've ever seen the original Star Wars movie, as they're escaping the Death Star and they're fighting off the TIE fighters that are attacking their ship, Luke gets all excited because he blows up his first TIE fighter, the enemy ship, and he tells Han Solo, he says, hey, I got him. And Han just says, that's great, kid, but don't get cocky. And that's the attitude that we have to have with trading. Yeah, celebrate your wins, but don't get cocky and think that they're all going to be easy trades and that they're all going to be that super successful. Just take it, 10 trades at a time, work your way through them, and reassess from time to time and say, okay, I've shown consistent profits over a good period of time. Yes, I'm going to increase my trading now. Don't just start increasing your trading because you've had a few winning trades in a row. Okay, so those are Gann's 24 rules or 24 never failing rules for trading. And remember, they've been tried and tested in the markets for a long, long time. They're not just something that Gann wrote overnight. You can see throughout his career, he wrote a few books and the rules were pretty similar all the way through there with a few slight modifications. So obviously they've served him well over a long period of time there. The suggestion that I would have for you after watching this video is to now go back and revisit your last 3 losing trades. Have a look at why they lost. See if you can work out whether you've perhaps broken any of these 24 rules. Maybe you traded without a stop loss order. Maybe you averaged a loss, for example. Maybe you jumped out of the market too early because you didn't want to give back your profit. But have a look at those rules and see if you've broken any of them and see what you can learn for next time. Trading is a marathon, it's not a sprint. You don't learn everything that you need to know about trading on your first day. You keep learning as you go on, and that's what makes a better trader. If you stick around long enough, you're going to learn these things over time. That's all for this video. I hope that you've enjoyed it. If you'd like to see more videos like this, make sure you click on the subscribe button below this video to subscribe to our channel and keep yourself up to date with our future upcoming videos. Thanks again for watching, and I'll see you in the next video.